All right, let's dive right in. Today, we are talking about the massive, high stakes world of bond trading, and we're going to look at it through the lens of one company, Tradeweb Markets. Now, if you're an investor, this is a really fascinating story. It's about a tech company, a challenger that's trying to take over a huge, kind of old school market that's finally going digital. I love this quote because it just perfectly captures the whole situation. When you hear teenage years, what do you think of? Kind of awkward, lots of rapid growth, and just a ton of potential. That's what's happening here. It means that a huge piece of this multi-trillion-dollar market is still, believe it or not, stuck in the past, running on phone calls. So the move to electronic trading, it's not even close to being over. There is a long, long road ahead. So let's just set the scene a little bit. For decades, if you wanted to trade bonds, it was all about who you knew. It was a game of relationships, phone calls, very manual. But that's all changing. People are demanding more speed, better prices, more transparency. And that's forcing this massive shift to technology. The big question isn't if the bond market will go fully electronic, it's who is going to build the platforms that everyone uses. And this slide right here, this shows you just how much room there is to grow. We're looking at a really important slice of the market, U.S. investment-grade corporate bonds. Even here, just under half, 48%, of the trading is electronic. Think about that. That means the other 52%, that bigger piece of the pie, is still done the old-fashioned way. That giant slice is the prize. That's what companies like Tradeweb are fighting over. Okay, so how exactly is Tradeweb set up to win this prize? Well, they've been at this for a while. They were founded way back in 1996, so they were one of the true pioneers here. And to really get why they've been so successful, you have to understand the powerful engine that's at the very core of their business. And that secret sauce? It's a little concept called network effects. It's the exact same idea that makes giants like Facebook or Amazon so hard to compete with. It's simple, really. The more people who use the platform, the more valuable that platform becomes for absolutely everyone. It's a powerful, powerful advantage. And this is a perfect illustration of how that works for Tradeweb. It's this amazing self-reinforcing cycle. So it starts when more big banks, the sellers, join the platform. That means more competition, which leads to better, tighter prices for buyers. Well, guess what? All those great prices attract more buyers, like big investment funds. And that huge flood of buyers makes the platform even more attractive to sellers, and the flywheel just spins faster and faster. Once it gets going, it's incredibly hard for a new competitor to break that momentum. So you might be wondering, does this flywheel concept actually work in the real world? Well, this number pretty much says it all. 25. For 25 years in a row, through the dot-com bust, the '08 crisis, you name it, Tradeweb has posted record annual revenues. That kind of consistency tells you that this business model isn't just theory. It's incredibly powerful and incredibly resilient. But hold on, Tradeweb isn't alone here. This whole digital revolution has turned into a full-blown competitive battle. And the fiercest fighting is happening in the U.S. corporate bond market. That's the real prize, and this is where the war for the future of bond trading is really being waged. And it really boils down to a classic showdown between two main rivals. In one corner, you've got the incumbent MarketAxess. They've historically been the leader in electronic credit trading. And in the other corner, you have the challenger, Tradeweb. They've always been the king of government bond trading, and now they're making a super aggressive push right onto MarketAxess's home turf. So let's check the scoreboard. As of 2024, MarketAxess is just barely holding on to that top spot with 37% of the electronic market. But look at Tradeweb. They are right on their heels at 34%. We're not talking about a distant number two here. This is a neck-and-neck race for the crown. And this chart just makes it crystal clear. Yeah, there are other players in the game, but the fight for number one, it's a two-horse race. From an investor's point of view, this is maybe the most important part of the whole story. You're seeing real market share momentum. Tradeweb is actively taking ground from the longtime leader. So how are they doing it? What's their strategy? Well, they've got a few key moves in their playbook. They've really dominated with something called portfolio trading, which lets big investors trade huge baskets of bonds all at once. It's super efficient. They're also pushing hard overseas, especially in Asia. And they're making smart purchases, like buying a company called ICD to get direct access to a whole new set of customers, corporate treasurers. And all of this brings us to the big question, the one every investor has to ask. The growth story is fantastic, the opportunity is massive, the business model is solid. But what's it worth? What price do you have to pay to own a piece of this story?
First off, there's just no arguing with the numbers. The company's financial performance has been spectacular. We're talking consistent double-digit revenue growth, and because it's a tech platform, it's super scalable. That means as revenues go up, their profit margins have been getting wider and wider. It is an absolute financial powerhouse.
But that performance comes with a hefty price tag. This slide shows us the price-to-earnings ratio, which is basically a quick way to see how much you're paying for a company's profits. And look at that. Investors are paying around 38 times Tradeweb's expected earnings to own the stock. That's a serious premium compared to its rival, MarketAxess. What this tells you is that the market is betting, and betting big, that Tradeweb's faster growth is going to continue for a long time. Now, when you pay a premium price like that, it means there's not a lot of room for things to go wrong. And there are real risks here. First, the competition isn't just going to roll over and give up. Second, a lot of their revenue is tied to how much trading is happening in the market. If things get quiet, their volumes can drop. And finally, it's what's known as a controlled company. This just means one major shareholder has a huge amount of influence, which can sometimes limit the say that smaller public investors have. So let's boil this all down, right? When you're looking at this as an investment, you're really left weighing two very different stories about where this company is headed.
On the one hand, you have the bull case, the optimistic view. You're buying a winner in a massive industry that's going through a once-in-a-generational technological shift. The business model is a fortress, and it's getting more profitable over time. But then there's the bear case, the reason to be cautious. You're paying a very, very high price for that great story, which means you're betting the company can keep executing perfectly against some really tough competition in a market that can be unpredictable.
And so that leaves us with the final question, the one that it all comes down to. You've seen the evidence, this huge market opportunity, the powerful business model, the intense competition, and that steep, steep price tag. So is Tradeweb's powerful growth story actually worth the premium? That is the multi-billion-dollar question that every investor has to answer for themselves.